This is David Ranson. Welcome to our webcast for August-September 2025. The topic this time is commodity prices, specifically oil prices, as a predictor of stock market returns, something we've done a fair number of papers on in the last 24 months or so. The beginning of the story is not with the oil price, but with the price of gold. Going back even more years, it's played a big role in our predictive work. And the price of gold is a major feature and progenitor of inflation in our work. And we've produced a number of graphs which demonstrate that. This is quite an old one. It shows consumer prices throughout the developed world as that is the inflation rate for consumers plotted against the change in the price of gold and averaged over a long period of time. The time period isn't shown here. It begins in 1972, and I think it runs through about 2000. And as you see, the countries with the largest gold price changes uh, are such as Italy and New Zealand on that occasion, as well as the UK. Those are high gold price increases, and they are also high inflation rates. But it's not a very precise relationship. However, it does show broadly a one-to-one connection between the price level and the gold price. In the US, we've done quite a bit more work, and this one is an analysis of the time frame over which the price level responds to a change in the price of gold. As you see, there's not much of a response in the first year. Let's suppose the price of gold rises in a one-year period, or it could fall in a one-year period. The beginning of the two upward sloping lines in the upper graph shows the amount of CPI response, which is pretty small. The difference in the gold price changes averages 28%. That's because there are 24 years in this history in which the price of gold rose, and the average rise for those 24 years is 20%. There's the other 21 years are years in which the price of gold fell, and the average fall in the price of gold for those 21 years is 8%. The difference between minus 8% and 20% is 28. So to get a one-to-one relationship, the CPI should ultimately rise by 28%. Well, we can see how rapidly the CPI does that in the lower graph. This is the percentage difference in the upper line and the lower line in the upper graph. And you see that over a 10-year period, we do reach a 20%, maybe 21% difference. So it would still take some more years to get up to 28. So the broad conclusion is gold is definitely related very, very closely to consumer price inflation, but it takes many years for this equivalence or equality to show up. We can't expect the price of gold to have immediate effects on the inflation rate. Now, if we go back to the emerging world and play the same game, we have much larger CPI rises to deal with and much larger depreciations in the currencies and therefore in the price of gold, in local price of gold. And we see here We've actually got to plot the data here on a logarithmic scale in order to include the really big the countries that do the that have the biggest effects, Brazil and Argentina. And you see this is the average annual average change in consumer prices measured along the vertical axis. For Brazil, over this time frame, which is 1980 to 2012, 32-year time frame, you see Brazil had doubled its price level. That's on an average annual basis. That is the extreme country. And countries like Malaysia and Thailand, back in those days, were very well behaved and had low inflation rates, and they tied their currencies back in those days to the dollar, which was also fairly closely related to the price of gold in the earlier years. Gold is also a market signal. The reason why we are starting with inflation is that inflation is a connection with the performance of the economy. The performance of the economy is closely tied to the stock market. They're all chained together. So the first piece of the first leg of this this chain, is gold as a market signal for real GDP growth. And we see substantially different real GDP growths, growth rates. These are measured over a 2-year time frame, though. Don't think it's all immediate. Again, there's a time delay, but the time delay with growth is much shorter than what we've just been seeing with inflation. The inflation data are very slow to respond, but the growth data are pretty fast. They're still not instantaneous, but we see here a strong relationship between the change in the price of gold, we could call that the depreciation of the dollar relative to gold, and the growth of GDP. So that's a step towards the stock market. If we look at the stock markets around the world, including the US, and divide the history into the years in which the return from stocks, the years in which the price of gold in local currency rose on the left and fell on the right, big difference, of course. Much lower stock market returns when the price of gold rose, and higher when the price of gold fell. That's what you would expect from the previous chart, in which we were looking at real GDP. Notice, though, that for these different countries, the gap between what happens when the price of gold rose and when the price of gold fell is not the same for all the countries. It varies quite a bit. We're looking here at 3-year returns from stocks. So again, it's not a simultaneous relationship by a long shot, although it's much more close to a simultaneous relationship than the relationship with inflation. The best way to see on a graph the inverse relationship that we were just looking at between gold and stocks is to plot it this way, just plot the data on a regular, I think this is a monthly basis for gold and the S&P 500, and it's very clear that there's an inverse relationship. When I don't know how clear it is, how long the lag is, you can't really tell, but you see very strong an inverse relationship. And so this is the first step, really, towards using commodities as a price basis, as an input for forecasting the stock market. One last question about inflation or about gold and stock returns. It is worth asking, has this relationship changed? So many relationships in economics have changed over the decades, and we're looking back here to 1950. This is a fairly old graph too. It ends in 2000, but it does show that if you compare the period 1950 to 75 with the period 1976 to 2000, you get about the same kind of response, comparing or contrasting the effect on markets on the US stock market in this case, from a rise in the price of gold and a fall in the price of gold. I'm taking the three largest increases in the price of gold on the left, the three largest declines on the right, and then all the other years are changed, are in the middle of the graph. So it does seem to be a stable relationship. It's been around a very long time. And the more work you do going further back into the past, the more that becomes clearer. Now, oil. The oil price is very different from gold, as we have been observing in recent years, and especially recent months, when the price of gold has been rising dramatically, when the oil price has continued to fall, as it's been falling for the last couple of years. Here's a graph showing over a 4-month time frame the effect on inflation. In this case, I'm using the PPI of a rise or a fall in the price of oil. I've divided the data actually into quartiles. So the top quartile represents a rise in the oil price in the first month of 13%. The bottom quartile represents a fall in the price of oil, averaging 11% in the first month. And as you see, there is an impact on inflation on the PPI that's pretty large in the first month, but after a second month, it's much larger still, doubles, and it keeps on rising until you get to at least 4 months. Then it's stabilizing at that point. So there's a time lag involved here, but the time lag in the producer price inflation rate is not as long as the very long time frames that we saw for the consumer price index. So we know that oil is related to inflation. We know that gold is related to inflation. How about the relationship between gold and oil? Well, this is shown by the parallel between the red line and the blue line in this graph. You can see the red line represents not gold in the spot market, but gold in the 20-year market. The reason for it actually is a closer parallel to show it in the forward market, and that's why I've shown it here. The reason is that gold is a safe haven investment. So when you have risk fluctuating in the world, as of course it has been substantially in the last few years, then the spot price of gold is affected by that, and the relationship with oil gets weaker. But if you use the forward price of gold, especially very far into the future, and we have plenty of data that would tell us what the 20-year forward price of gold should be, and that's why I've chosen a 20-year horizon. In that case, 20 years out, nobody has any idea what kind of risks and threats there might be to worry about. So gold 20 years out, the forward gold is simply not a safe haven in the same sense that the current price or the spot price is. So there you see a very, very impressive parallel. Nevertheless, it's not perfect. And to show the imperfection, we have a third line in the graph showing the ratio between oil and forward gold. And throughout all of these data, because the changes over a long period of time are very large, I'm using a log or a ratio scale, as you see. Well, the ratio of oil to 20-year gold varies enormously. It reached a high sometime in the 2005 era of 0.05, which is 20 barrels per ounce, and a low much earlier, back in the 1980s, it was below 0.01, about 0.007. That's 100 or 200 or maybe 200 not quite 200, but maybe 150 barrels of oil per ounce of gold. That's an enormous range of variation. In spite of, but it's superimposed on, there's no doubt that there's a strong parallel between the two. They are correlated. You can see the parallel in another way by looking at the beginning point of the ratio in the black line, which is about 0.02, about 50 barrels of oil per ounce of gold. And you see that it was still 0.02 as little as a year ago or 2 years ago, back in 2023. So it's gone nowhere in all these years. 1932 to the present is getting on for a century, and the ratio between gold and oil is in the same ballpark as it was a century ago. That's incredible, especially because of the contrast with the range of variation. So, in the short run, in other words, we cannot see that oil and gold are related at all. We have to look at a very long time frame to see how very closely related they are. Now, to look at the another step in forming this chain of links is to look at the oil price and the stock market. And we find here a shorter lag, but still a lag, about a year, and an inverse relationship, as you might expect, since oil represents the costs of raw materials for manufacturing and other ways in which it represents the costs of doing business in general. We have this, therefore, an inverse relationship. But notice that the time lag is 12 months. It isn't simultaneous. Even though the market is very clever at anticipating what may happen and is not slow to represent the facts of life, if the oil price changes, the stock market certainly knows about it immediately. Nevertheless, there's a time lag before the market prices it. And this is the basis for forecasting the stock market based on commodity prices. You see here not a perfect relationship, but a very strongly inverse relationship. Back in 2013 or 2014, 2015, you see, actually not 13, but 14 and 15, you see a positive relationship between the two, not a negative relationship. And that is true going much further back. We can take this relationship back all the way to the World War II and beyond. We have a history of oil prices, certainly going back to about 1932, as we saw in an earlier graph. And this imperfect but strongly inverse relationship exists all the way back. So oil prices and the correlation is obviously very high. And so it's actually higher than any correlation you can get from recent gold price changes and the stock market's performance. But the gold price is a serious part of the story. And rather than use the oil price alone to forecast stock markets, I'm using both the gold price and the oil price connected together. And the way I do that is to show the oil to gold ratio and the gold price. Then again, this is the forward gold price, the 20-year forward gold price. Here's the history. I'm taking this history back to World War II. And we see I'm using 4 categories to divide the history. And in one of them, the oil gold ratio and the forward gold price both rise. And that's the subsequent S&P performance. It is 1 year later, or I think this is 2 years later. Let me see. S&P performance depends on whether there was a fall or a rise the year before. Yes, as we saw before, the oil price relates to the stock market with a 1 year lag, but the gold price relates to the stock market with a longer than 1 year lag. So this picks up at least part of the double relationship, if not all of it. So when the two variables, the inputs, the ratio of oil to gold and the forward gold rate price itself, both rise, we get the lowest stock market in the following year, 9.9. When they both fall, that's in the fourth of these bars, we get the highest, 15.6. And then the intermediate cases show that the oil price, the oil gold ratio is a more powerful variable in the short run than the gold price. Now, putting it all together, we've got two commodities and the stock market, just three variables to tie together. Very, very simple. And you can use least squares to put together a formula, very, very primitive formula, a least squares formula, the percentage change in the oil price, the percentage change in the gold price, that's forward gold again, and the following year's percentage change in the stock market, or the total return on the stock market. That's the relationship that I'm using. And I've carried it back again to 1945. It's not as stable prior to 1945, but it still gives us something like 80 years of history. And we can fit a least squares relationship to that 80-year history. And in this chart, I'm not showing all 80 years. You wouldn't be able to read anything if I did that. I'm showing the most recent years, which would be the years of most greatest interest, of course. What I'm doing is to solve this equation, which is fitted by least squares, for various target stock market results. So, for instance, if we want to know what kind of gold price behavior, oil price behavior produces a 20% return in the stock market, you see it on this graph. We can compute it from the least squares relationship, and you see it's an oblique pale blue line on the graph in the left lower left area of the graph. That's the 20% estimate, you could call it, but it's the best word for this is an isoquant. It's rather like the isobars you see in weather maps. Those are lines of equal pressure. Well, this is a line of equal forecast. So that's where you would expect to get a 20% stock market return. And the market hasn't produced, sorry, the gold and oil commodity prices have not produced an expectation of a 20% market return in this time frame. There are other things involved. The biggest stock market return in this time frame occurred in 2021, but we can all see very quickly what would have caused that. Of course, it's the bounce back from the pandemic impact on the stock market in the year before. Because of these other factors, the stock market is quite a bit more variable than what you would expect from gold and oil alone. But gold and oil give you the basis for a forecast. And the variability is very unpredictable. It all depends on what kind of factor is playing a game, and even on the timing. If you have a pandemic, then the market does badly in the early stages of the pandemic, but it does very well, bounces back, it compensates in the later stages of the pandemic. So you can't really use other factors as easily to get a more precise expectation of the market. Having said all that, these red blobs, which represent the actual market outcomes, the red blobs represent the expected market outcomes based on gold and oil, the oil-gold ratio, and they're all labeled by the time frame. I'm using calendar year averages, otherwise the data would be very much more variable than they appear, and that's really necessary to find out what the relationship really is. And the blobs really fairly much fit a pattern in which the weakest stock markets, although the markets that are expected to be weakest, would be in the top and right of the diagram. And you see 2022 was the weakest market. If you compare the average for 2022 with the average for 2021, that was a slight decline in the S&P 500. It was a negative total return, and it's up there. And so that fits the general pattern in which a large rise in oil or oil-gold ratio and a large rise in gold are negative for stocks. In the lower left corner, there aren't any data points. I mentioned the oil and gold have not in this time frame ever predicted a 20% market. But we have had a 20% market. The 2021 market, thanks to bouncing back from the pandemic, was a 36% return on the market. Well, that still fits the pattern, even though numerically it's very much larger than the simple equation would have anticipated. Now, having described what all of the background is, look at the blue star. There's a blue star in the lower right of the diagram, representing a more than 40% increase in the gold price. That's over the last year. Very large increase in the gold price. And the change in the oil has actually fallen. So the ratio between oil and gold fell even also about 40%. Not much change in oil. And that gives you the location of the asterisk or star, and the star enables you to read off very quickly a forecast for the stock market in 2026. The timing of plotting the star on this kind of map is the end of August, as shown. And so this is a forecast for the end of August 2026. And it lies between where we'd expect to get a 10% forecast, a 10% outcome, and a 15% outcome. It's been in that area for quite a long time, and it's closer to the 10% line than the 15% line, which means you can easily interpolate that by eye. So the easiest way to produce a forecast with a diagram like this is very easy. You can quite easily see we have there a 12% anticipation for the market between August this year and August next year. So that shows you the way I would use this forecasting model in practice. I'm going to be publishing this estimate very shortly for the end of August, and probably every 3 months we'll publish it again. And what will happen is that the diagram will remain much the same as it is here. Probably it could be exactly the same for 2 or 3 quarters, but what does change is the location of the blue star. And as the blue star changes, we can read off the forecast. So very handy. And that's the end of my comments on using economics and commodities for forecasting the stock market. I don't know of any other inputs economists can come up with that would do a simpler job and a pretty good job of anticipating the stock market. It's a notoriously difficult thing to do. So thank you. That's the end of this webcast for this period, and I look forward to the next webcast 3 months from now in November or possibly December. Thank you for listening.